Okay, so welcome everybody to a different version of the AFA than we are used to. Very much looking forward to this session. A little bit sad to not get to see and interact with everyone in person, but we still have a really good session going today. So the first paper is going to be Momentum Turning Points. Christian Goulding is going to present. Authors are going to have 25 minutes, discussants 10 minutes, and then we'll do 5 minutes for Q&A, which you can enter through the chat, and feel free to enter those during the presentation. So I'll turn it over to Christian. Thanks a lot.
Okay, thank you. So this paper is joint work with Ashish Garg, Cam Harvey, and Michele Mazzolini. And what we look at here is, at a basic level, time series momentum strategies and turning points in those strategies. Now, time series momentum strategies are based on two simple premises. One, expected returns vary over time, and two, the signs in expected returns have some persistence. Expected returns positive now, likely to remain positive going forward. And these premises are theoretically and empirically grounded. And if these premises hold, and this has been shown in the literature, then we can exploit this in time series strategies by just looking at trailing returns over some horizon. And if those trailing returns are positive, take a long position, otherwise take a short position. So if those premises hold, there's still one problem, is that the trend's directions can change. And if they change, since those realized returns, which are in our trailing return signal, are a mixture of the trend and noise, at turning points where trend is going from up to downtrend or vice versa, time series momentum is prone to place bad bets. Now, the trade-off between reacting quickly to a potential turning point and not reacting to noise is going to vary by speed. So we use the terminology of speed to denote look back length. So for example, a slow speed strategy would say have a 12-month look back window for returns. And for a slow strategy, this would reduce the influence of noise by averaging over a longer period, but it's going to be slow to react to a turning point, or so-called a type 2 error, because we're missing the detection of a turning point if it occurs. It takes a long time for the slow signal to catch up. If we go with a fast signal, say a 1-month look back, that's going to be fast to reacting to a turning point, but it's going to be more influenced by noise. So you're going to have a type 1 error of a false alarm, no turning point actually occurred. So our main research question of this paper is, can we react more effectively to turning points? We start from the most basic time series momentum strategies and build up a family of linear blends of these. So the first two strategies we start from are the slow and fast. So for us, the slow is the 12-month trailing return. This 12-month trailing return is a standard horizon in time series momentum literature, and it's simply this: go 1 unit long if the trailing 12-month return is positive, otherwise go short 1 unit. And similarly, the fast time series momentum strategy is go long 1 unit if the trailing 1-month return is positive, otherwise go short 1 unit. Now, from these two, we build up a family of intermediate speed strategies based on a linear blending parameter between 0 and 1, which we call A. So for example, the medium strategy, where A equals 1/2, is just a 1/2, 1/2 blend of the slow and fast weights. And so you can see that this will end up with 3 potential positions for the medium strategy. If both the slow and fast agree, then they would be, they'll be the same, and the average will be a +1 position. If they disagree, one is positive, the other negative, then it's going to be 0, and the medium strategy will be out of the market. And then, of course, if they both agree and are short, then the average will be short. So there's 3 possible positions there. And then the other strategies are some blend in between. Now, there are other possible, more complex versions of this. This is the simplest possible version. Think of this as an illustration to get started with the idea. And we could adjust by magnitude of the positions and so forth. But we want to start with the simplest framework to really get at the idea of turning points, as we'll see next. So all of those, that continuum of linear strategies that we looked at, are dictated by these four simple states. If we were to intersect the slow and fast signals, the trailing 12-month and 1-month signal, and we look at whether those are positive or negative, we get four different states, which we loosely label bull, correction, bear, and rebound. The idea with the bull state is that if the trailing 12-month return and 1-month return are both positive, we call that a quote bull, and that's a case where both strategies are indicated to take a long position. However, if the 12-month signal is positive, but the 1-month is negative, we call that loosely a correction state, indicating the possibility this could be a turning point and might be going into a bear market. And if we are in a bear market, both the slow and fast signals are short because the 12-month and 1-month are negative. And then similarly, a rebound, if the 12-month signal is negative, but the 1-month is positive, this could be a potential turning point from downtrend to uptrend. So we label this as a rebound. Okay, so it turns out that these four simple states derived from these simple binary strategies are predictive of the next month's return for the US stock market. So here we plot the average return, volatility, and skewness of the US stock market over the last 50 years following each of the four states that I just listed. You can see that there is separation that occurs from these states. So these states carry information. Following a bull state, you have about an average of 9.5% monthly return, the lowest volatility of the various states. And as you move to a correction state, average return comes down, volatility goes up somewhat, indicating the potential of reverting to a bear market, in which in the bear market, average returns are negative and the highest relative volatility. Then volatility following rebounds reduces somewhat, returns come back positive. So there's information that appears to be contained in this just simple four-state partition of the history of returns. So let's look at the properties of the different types of time series strategies at different speeds and of the market return itself. So we're going to look at just the underlying US stock market performance statistics, and then the statistics for the slow or 12-month momentum all the way through the various speeds up to the fast 1-month momentum. And we're going to look at this in three parts. Part one, we're going to look at the risk-adjusted performance in terms of volatility risk. Part two, we're going to look at the downside behavior. In part three, we're going to look at the beta of these various strategies to the underlying market that the time series momentum is picking up. So if we look at the average returns, now just for a buy and hold strategy in the market over this 50-year period, it's about 5.9% excess return. But if we look at the time series momentum strategies ranging from slow to fast, we see, of course, since these are just linear combinations of the slow and fast, the average return, of course, is linear between the two ends. However, when we look at the volatility of these time series strategies, we see that the volatility is lower for intermediate speeds. And for this particular sample, the median speed has the lowest volatility, leading to the highest Sharpe ratios. Now, you could explain this very directly just using a diversification argument. If the slow time series momentum and the fast time series momentum are relatively uncorrelated, then blending the two equally would get you some diversification benefit and you could get a higher Sharpe ratio. However, we approach this a different way to provide a different perspective in terms of how turning points are affecting this result. So we derive the following expression that the Sharpe ratio of any time series strategy of any of these speeds is just the weighted average of the Sharpe ratios of the slow and fast momentum strategies multiplied by what we call a disagreement multiplier. This disagreement multiplier reflects the relative value of volatility of returns overall to volatility of returns following bull and bear states, the so-called trend states, and volatility following our turning point states, the correction and rebounds. And interestingly, when A is equal to 1/2, that's the median speed. This term in the denominator, which reflects the variance following those turning point states, drops out, making this multiplier the highest value and leading to the highest Sharpe ratios. So what we can see here is that when you reduce exposure to the risk following those turning point states, that leads to the higher Sharpe ratio. This one potential importance of detecting turning point states. Now, if we look at the full distribution of returns following each one of the appearance of these market states, what we can see is that following the observation of a bull state, subsequent monthly returns range from around minus 9.5 to positive 9.5, with a little bit of tilt towards the positive. Following bear states, there's much more volatility. The returns spread out. But interestingly, following correction states, you see the most downside risk. And in fact, returns following corrections have some of the most extreme outcomes on both sides. 5 of the 10 worst months in the last 50 years were after correction phases, and 4 of the 10 best were after correction phases. So turning point states, as just indicated by these loose definitions, again, there's potential importance here for time series momentum strategies. So this carries over to downside risk. So if we look at the skewness of the market itself, so just this, the US stock market is negatively skewed, and so is the slow 12-month momentum strategy. But as we move across and increase the speed up to the fast, it quickly becomes zero and into the positive range for skewness, investors wanting, of course, positive skewness or a less negative skewness if possible. But once again, we can decompose the skewness of any one of these speeds of time series momentum into a weighted average between the slow and the fast skewness, multiplied by that same disagreement multiplier that we saw earlier. But interestingly, shifted to the right by the Sharpe ratio of that strategy itself. So we see this evident here for the US stock market. The skewness for the slow momentum strategy is negative 0.43. For the fast, it's positive 0.15. Now the average of these two would be negative, but because of this shift to the right that comes from avoiding exposure to those turning point states, the median strategy actually has a slightly positive skew. And this is something that's a general result we can expect in e-market, not just in this example for the US stock market. So third, we look at the role of market and volatility timing. So a very widely used decomposition of expected returns is as follows. The expected return of any strategy can be expressed as the covariance of the strategy weights with subsequent returns, the so-called market timing. And then the static component, just the average weight that the strategy takes in the underlying market. Now, for example, you could have a situation where the time series strategy tends to be taking a positive position more often than negative. For the US stock market, we know that trailing returns tend to be positive. So overall returns tend to be positive more often than they are negative. About 75% of the time, monthly returns in the US stock market are positive. So if you take a time series momentum strategy, apply it to the US stock market, you can say, well, look, just 75% of the time, you're just taking a positive position. Therefore, what are you really adding here? Maybe you're just picking up the beta that's of the underlying market. So to get at answering this question, this potential issue of where's the contribution coming from, we provide a new decomposition of the market beta. So the beta of the time series strategy with respect to the underlying index that it's applied to. And in this decomposition, we indeed have the static component, so on the average weight of the strategy. We also have the market timing component, which takes into account the covariance between weights and subsequent returns, just as in the market timing component. But interestingly, there's an overlooked additional component to complete the equation, and that involves the covariance of your time series weights with the squared deviation of returns from their average, so-called a volatility timing. Can this make a difference? Well, we see that it does make a difference when applied to the US stock market. So here, once again, are our slow through fast strategies from left to right. And if you look at the static part of the beta, so the average, basically the average position the strategy takes between plus and -1, they're all positive. And for this momentum 12, it's an average of 0.45. So with the weights being between +1 or -1, this represents about 75% of the time being positive. Okay. You think, okay, well, these picking up a lot of beta. But if you look at the actual betas, the betas are much lower. And in fact, as we increase the speed, the beta becomes near zero and even negative. So what's going on here? What's going on is the volatility timing. The volatility timing component is taking down these betas. And what's the argument here is that, of course, if we know that for equities, volatility is contemporaneously negatively correlated with return. So if volatility happens to be low, returns are also contemporaneously high. So trailing returns that can negatively predict volatility will be positive predictors of returns. Okay, and that's going to come through in regardless of the speed of the strategy. Okay, so far we've looked at static blends of the slow and the fast time series momentum strategies. And for the medium speed, we saw that this always stays out of the market, because when the two strategies disagree and you take an average, the weight is always zero, it stays out of the market. Well, can we do better? Can't we get back in more often, potentially improve on the performance? So what we ask here is, if we were to, instead of just taking a fixed speed regardless of the state of the world, what if we adjusted the speed based on the occurrence of one of those four states that we observed? So we asked the following question: how can we maximize the Sharpe ratio of a strategy that takes a different speed following the observation of a bull correction or bear rebound? The solution to this is that, of course, after bull and bear, since both the slow and fast agree on either +1 or -1, it doesn't really matter how we blend the two, it'll always be +1 or -1. But following these potential turning point states, these corrections and rebounds, we get a non-trivial result. But the result is intuitive. So if we look at these equations, ignore this larger fraction here, which is sort of a normalization constant common to both of these speeds. We look at the highlighted fraction in blue, for example, for the speed following corrections. If the expected return following corrections is positive, let's say, what does that mean? That means that the speed, because of this negative sign, the speed should be slower. But what does it mean for the expected return after correction to be positive? It means the trailing 12-month return was positive. The 1-month return was negative, since we're in a correction, but returns following that state tends to be positive. So in terms of indication of what the strategy should do, we should follow the slow speed. And so this slows down the speed and stays in the market, stays with a positive weight. And on the flip side, for rebound, it's the other way around. Of course, if the expected return following rebound is positive, then we want to increase the speed, go towards a fast signal. Because what does rebound mean in this definition? It means the 12-month signal was negative, the 1 month was positive, indicating a potential turn from downtrend to uptrend. We want to follow that uptrend if returns following rebounds are positive. And if we take these equations and estimate them using all the data we have, let's say 42.5 years prior to the beginning of the 50-year period, estimate all those values for the speeds based on sample moments, then create an investable strategy that fixes those speeds over the entire valuation window, we see that the estimated speed following correction is indeed to go slow. In fact, in this case, completely slow down. And after rebound is somewhat intermediate to a slightly fast speed. And that results in a Sharpe ratio of around 52. Now, relative to the best we could have done, the so-called oracle, the optimal, that means if we knew all the returns that would happen over that 50-year period ahead of time, and we were to pick the best possible speeds following each of those four states, the best we could have done would have been a 57 Sharpe ratio. So this dynamic estimated strategy from history is over 90% efficient. And this is true even as we take in more and more data with, of course, a smaller window of estimation and evaluation. But if we go even say to the last 15 years using 70 years of data, we see the same pattern. The dynamic strategy is very efficient at picking up the best of what can be done and sort of tracks the behavior over time. So if the Sharpe ratio is high in potential, the dynamic strategy is able to be high as well. So there it is picking up some information. Now, how does it compare to the static speed? So here we have our 50-year evaluation window for slow through fast. These were just the static blends. And we saw before that the highest Sharpe ratio occurred for that median speed, the 1/2 speed. Now, over the 50-year period, the dynamic approach does a little bit better. So we don't see any decrease in risk-adjusted performance by following the dynamic strategy. And we do see the potential for notable gains. So for the last, in the 15-year evaluation, the dynamic strategy is able to pick up more returns. So there's potential to get back in the market and actually do a little bit better and manage the risk following turning points. And the message that we take away is illustrated in the following graph. If we look at all the possible speeds after corrections on the x-axis and all the possible speeds we could have taken after rebounds from slow to fast, look at where the best possible speed was, this optimal one, the one as if we knew all the returns that were going to occur ahead of time. The indication is slow after corrections and fast after rebounds. And that's roughly where our dynamic strategy ends up from the estimation. And even if we were to take a different whole sample of history by using, say, block bootstrap historical samples of our history to estimate our dynamic strategy, here's 1,000 cases of them with these brown dots. We see the same general message that the indication is to go slow after corrections and fast after rebounds. And the performance surface for the Sharpe ratio levels is relatively smooth in this area. And finally, we apply this methodology to international markets. And once again, we see that the same rule we saw before, that the median static speed strategy is always better than the average of the slow and the fast. And in nearly every case, the dynamic strategy outperforms the best of any of the static speeds, with the exception of Japan. But even in the case of Japan, the performance is better under the dynamic strategy than either of the fast or the slow speeds taken individually. And once again, estimating market by market tends to be the case that the speed after corrections that's indicated from the estimation is slow, and the speed after rebounds is more on the fast side. And this is even true if we pool all the data and just treat it as one global estimation for each of the speed after correction and rebound, same indication. So in conclusion, we see that intermediate static speed strategies have many advantages over the simple slow and fast strategies. We see higher Sharpe ratios that pick up from getting out of the markets following turning points, less severe drawdowns, more positive or less negative skewness, again, tied to the behavior of the strategy following these potential turning points. We also see that these simple market cycles are useful for explaining the phenomena. We can expand on this, make them more sophisticated, but even at this kind of coarse partition of the history, we see some benefit. We also see that volatility timing plays an important overlooked role, that momentum weights can be strong negative predictors of return volatility, which will lead to betas that are lower than the static tilts might imply. And then finally, we can optimally time the speeds and get in more often following these turning point states, with these equity markets indication being slowing down after corrections and speeding up after rebounds. And of course, these insights apply to international equity markets. So that's what I have to share. Thank you.
Thank you, Christian, and thank you for being perfectly on time. The discussant for the paper is Ravi Jagannathan, and I'll just remind people again, I see some people using the Q&A feature. That's great. Feel free to add questions there, and then in the 5 minutes between papers, we'll get those answered. So go ahead, Ravi. Thank you.
Well, thank you for giving me an opportunity to discuss this very interesting paper. And thanks also to Hong Hao Wang and Kai Wang for excellent research assistance. Um, this is a long paper and there's a lot of things going on here. So the number of ways in which one can discuss this paper. And the first thing when I looked at it, the question that came to my mind is that if for some reason they limit yourself to say that, you know what, I can only observe the past 12-month returns individually, what's the best way I can forecast the next month return on the market and also the next month volatility, skewness, and all that. So that's a broader question. And I said, okay, let's not get into that. Let's assume that you're only given two signals, the average of the last 12-month return and the return on the last 1 month. And you don't even observe them. It just tells you whether it's positive or negative. And that's all that you have. You have a binary signal of the 12-month return and a binary signal of the last 1 month return. And without questioning, let's see what's the best way to use this information. Okay, that's the way I'm going to focus on this discussion. Okay, and so the first signal is last 1 month return is positive or negative. Second, which is a slow signal, is last 12-month return, whether it's positive or negative. And then when you have two positive up or down, you can put them into four. And the authors say, okay, let's call this as bull if the two signals are saying up. If slow says up and the fast says down, that's correction. And the slow says down and the fast says up. It's both say negative. I mean, down it's a bear market, and slow down and fast up is a rebound market. And the very interesting thing is that they have a picture, which I reproduce here, and I'm going to spend a little bit of time on this. It basically tells everything that is going on in terms of intuition here. And the most impressive thing that you see here is that the simple way of classifying bull, bear, and rebound and correction seems to capture what's going to happen next month. You only look back and you're able to say a lot of things about next month with a reasonable amount of precision. And here, look at it. The bull market has higher return and lower volatility than the bear. So I'm going to keep my attention on the bear market and look at all the other things relative to that. And so you can call this as either volatility timing or market timing, because both will get you there. Separate the bull and the bear. Now, if you look at the bull versus correction, the correction has a higher return, somewhat of a lesser volatility. So it's a stronger market timing signal between the two, separation. At the same time, some volatility timing is there. And if you look at the rebound and bear market, again, you have both market timing and volatility timing. And rebound and correction, it's market timing. Bull versus rebound is really volatility timing. Okay, so in some sense, it looks like the market timing, people typically talk about market timing and volatility timing. They're actually joined in the hip. But volatility timing, when you classify bull, bear, correction, and all this way, is a little bit weaker in terms of separation ability than market timing. And also notice that the correction is actually very negatively skewed. So when I stare at it, it tells me, okay, this tells me 4 states. And so I want to decide how I should take a position in each of these 4 states, because I know where I am a little bit ahead of time. And when I look at it, I would actually say I'd avoid correction because it's got a very potential negative skew, huge negative skew. So mean variance may not be the only thing I look at. Bull market, you want to be in the market. Bear market, you want to avoid. But rebound market, also you want to take a position. So keep that in mind. I'll come to that in a minute. Okay, these are the authors focus on 2 simple elementary strategies. And one is you go in the market or short the market if the slow signal is up or down. Similarly, for the fast signal, if it is up or down, you go either a long or short position in the market. Okay, so you tie your hands and say, these are the 2 elementary strategies. And of course, they say, okay, I can also form a portfolio of these 2 elementary strategies that I am allowed, and there I can choose any weight A. Okay, so your strategy space, not only that your signal space is very limited, your strategy space is also quite limited. Okay, And it doesn't cover taking different positions in each of the 4 states that they're able to very nicely classify. I'll come to that. Now, this table gives you very interesting facts of what happened. Look at the market beta. The market beta is 0. The alpha is humongous. It's 6%. So a market neutral strategy gives you 6% alpha, and the T-stat is 3.71. Sharp ratio is 0.51. It's pretty impressive. And one thing that you got to remember is that the average position is 0.32. What's the interpretation of the average position? In this, since you're only going into the market or in treasury bills, that position in the market is the conditional beta. Okay, so the average position is the expected value of the conditional beta of the portfolio. But the market beta is the unconditional beta. It's the covariance by the variance unconditionally. So the two things are quite different. The expected beta is 0.32, but the beta on, the unconditional beta is almost close to 0. The question that comes to you is why? Interestingly, this actually was studied. I actually looked into it in great detail in a paper I wrote with Zhenyu Wang, and it actually was re-derived in Llewellyn and Nagel also, the exact relation between beta and expected beta. And the authors come up with the same, rearranging the terms. You can get a very interesting decomposition of the beta into static. Static is really the expected beta. And then you have market timing and volatility components. And similarly, the authors derive a very interesting decomposition of the alpha into market timing and volatility timing. Okay, these are very interesting. I think this go beyond the simple strategies looked into this paper, so it's more general. Now let's look at the results. If you stare at the results, something that strikes you is that the alpha, the market timing component is about 65%. But you look at the beta, the market timing component is 0, and the volatility timing and the expected beta basically cancel out each other. So the beta is actually 0. So one would like to know is that how can you have a huge market timing component to alpha, but not for the beta? I have a little bit of a suspicion that it could be because that you are in the market when very sharp recoveries are taking place. You have to derive this algebraically, and it's possible to do that. I may be wrong in this claim, but some discussion about explaining this will make the paper very interesting. And then let's look at the in-sample performance. I'm not going to do the out-of-sample performance as in the paper. If you look at the in-sample performance, I'm going to focus on the 4 states. I'm going to represent the 4 states: bull, correction, bear, and rebound. And the slow strategy corresponds to taking, being in the market, which is 1, being in the market, which is 1 during bull and correction, and shorting the market in bear and rebound. The fast strategy I can represent as 1, -1, -1, and 1, which is you are out of the market or you short the market in bear and correction, and you are in the market in rebound and bull. And then weighted average strategy, the half, which does the best is actually 1, 0, -1, 0. You can see that weighted average of the 2 gives you this. But now, when I stare at it, the intuition gave me something that I want to be in the bull market and I want to be in the rebound market. And when I do that, I get a Sharpe ratio of 0.58. Do you see that? The intuition that I stared at the picture told me I should be 1, 0, 0, 1. And that's 0.58. It's an in-sample. Keep in mind, it's not out of sample. But then you cannot express this one as a portfolio of the 2. That's what struck me. So the question is, why are you tying your hands to portfolios of these 2 strategies? See, you showed me a very nice way of using 2 up and down signals to classify into 4 states of the market. But to carry over into strategies that tie my hand, I am a little skeptical as to why we should do that. So just staring at the picture gives you an answer which seems to be much better than any optimization. Actually, you can actually do the optimization here. Call that as W star. And that gives you 0.65. just in the mean variance space, ignoring skewness, right? If you put exponential utility, the skewness will also play a role here. Keep in mind, exponential utility, this is not normally distributed. So the skewness in the correction, in fact, it'll be a big factor for exponential utility. But this, you can see here, it's 1 in the bull market. You short, but you don't go fully short. You're only 0.25 negative. And you take a little bit of a position in the other 2, and you do much better, okay? But, you can also justify tying your hands if you think that you are over-parameterizing it, okay? So, but that needs to be proved or explained as to why that is the case. Limiting your hands and limiting the degrees of freedom may not be a bad choice to make sure that you don't over-parameterize or overfit. Okay, then the dynamic portfolio comes somewhat in between, because it looks like you can give different kind of weights to different states, but it's not exactly so, because the dynamic portfolio, what they call as different A's in different states, still make you constrained, because they constrain the weights to be, you take you 1 in the market if it's bull, and -1 in the bear state. So it's still constrained optimization. And so it's not clear why this is very interesting. And I also just plotted to see how it does. And I couldn't see any pictures because it's so many months. So I just took a moving average 12. And you can see here what you would expect of any statistical strategies, purely statistical kind of portfolio strategies. What you see here is that the strategy will work for a while, then it will break. It will work for a while and it will break. And this pattern repeats. And what it means is that when something works, word of mouth says everybody will start following it. If there's no fundamental reason that that's what you should see continuously going forward, it'll then, pattern will go away by arbitrage. And then when it stops working, people will get out of the strategy. And then whatever was the fundamental reason this thing showed up in the data to start with will start showing up again. And so I think I'm up for time, right? Tyler, do I have any more time?
No, you do not.
Okay, I'm done. Okay, thank you very much. A very nice paper. I enjoyed it very much. Thank you.
Okay, thanks a lot, Ravi. Did the authors want to, I have a question in the Q&A from John Campbell about why do we use dummies for the sign and ignore the magnitudes? And then there's another question that looks like it was answered. Maybe you can respond to Ravi in a couple of minutes too.
Yeah, just real quickly, thanks, Ravi, for putting together the discussion. I just want to address a couple of the points that you brought up. I think it's a good point regarding the market timing of beta being near 0, but the alpha being significant. And that is something that we should add some discussion around. We haven't looked at that in that particular angle. As far as expanding beyond the simple linear construction between the fast and the slow, I think it's a good point, and I agree. And what we're trying to do is start with that simple constrained environment to keep hold of the intuition of the idea that it's really about agreement and disagreement between the different signals. And so by blending the two, we're saying how much are you going to use the agreement of the signals? For example, if both of the signals are positive, the so-called bull state, would it make sense to deviate and not go long in that case? Now, you could make an argument for that by enhancing the model, as you've said, but we think just to stick with the simple intuition of you go long in that case when both agree. And similarly, you go short when both agree. So really the question comes down to what happens when they disagree? And you're right, we can do better. And that's what we try to do, is expand with the 4-state sort of dynamic model is to allow that to vary. But we see even with this simple case, without doing those further enhancements, which are certainly worth looking into, that we get interesting, robust performance just there. So sort of like a lower bar on what we could do.
Yeah, let me tackle John Campbell's question, which is a really good question. And that is, why do we work, and we is not just us, but the literature, work in terms of these bins where it's basically a binary signal, positive or negative. So the answer is fairly simple. Number one, we want to be comparable to the previous literature in the paper. And number two, this problem of figuring out what the dynamic speed should be is a really hard problem. It's like the holy grail of trend following is to figure out how much look back you actually take into account. So what we decided to do was to operate on something simple. And the simplest place to start is like the 0-1, positive or negative. And I do think that there's a rich research agenda in the future that takes the magnitude also into account.
Great, thanks a lot. So thanks to the authors and discussant there. We're going to move to the next paper. We're going to try to stay on time because it's going to automatically shut us down when time is up. So Benjamin Golez is going to present equity, duration, and predictability. You have 25 minutes.
Well, thank you, Taylor, and thank you for including our paper on the program. It's a joint project with Peter Koudijs, who just recently joined Erasmus University in Notre. So what we do in the paper is we address one of the more fundamental questions in finance. Do prices move because of changes in expected returns or because of changes in expected dividend growth rates? Of course, we're not the first ones to actually address this type of questions. This is a fundamental question, very much important for our understanding of how asset prices are formed. And that's why it's not surprising that there's a large body of work that tries to estimate the relative contributions of both expected returns and growth rates for price variations. However, the empirical evidence is mixed and quite puzzling. So the standard approach in the empirical work, as you know, is just to assume rational expectations and then consider simple predictive regressions of returns and dividend growth rates and dividend to price ratio on the lagged values of the dividend to price ratio. So, and then the estimated parameters on the relative predictability of returns and growth rates tell us something about the relative contribution of those two processes for price variation. Now, if somebody does that in the post-1945 period, then it's well known, and Cochrane also talked about it a lot in his presidential address in 2011, is that expected returns dominate. Almost all the price variation is due to changes in expected returns. However, if somebody goes back in time, then not only expected returns, but also changes in expected growth rates appear to be very important. And that comes out very clearly in our previous paper, where with Peter, we collected 4 centuries of data of prices and dividends. And we showed that returns are always predictable, but in the historical data, we also see a large or significant predictability of growth rates, which means that fundamentals back in the days actually also were very important for price variations. And these results are kind of puzzling. So why do we see this dominance of expected returns in modern markets? Are prices driven primarily just by changes in risk appetite and potentially even by animal spirits as put by Keynes and Schiller? Well, what's even more puzzling is that, if anything, expected returns should be more important back in the days, because nowadays we're better able to diversify and transfer risk. So what exactly is happening here? We think this is very puzzling, but we do provide one potential answer to the point here, which is that a piece of puzzle that's missing potentially is an increased duration of the equity market as a whole. So we can think of the duration of the equity market in terms of the timing of dividend payments, and then link duration to total payouts. When payout is high, then companies pay almost all their earnings in terms of dividends, growth rates are going to be low, and duration is going to be low. On the other side, when payouts are low, companies push eventual payouts of dividends into the future, growth rates are high, and duration is also high. So the inverse of the payout ratio is really a good proxy for the duration. And what we see here in the picture is this dramatic decrease in the payouts over time. Now, while firms kind of paid out somewhere between 0.7 and 0.8, so 70 to 80% of their earnings in terms of dividends at the beginning of the 20th century, that value decreased around 40% towards the end of the century. So as firms started to reinvest more of their earnings, or maybe they just potentially kept them on balance sheet in form of cash, payouts to investors have been pushed into the future. So as a result, today, we see that investors receive most of their returns in terms of capital appreciation. Dividend to price ratio is low and growth rates are high. And all this implies that the duration overall has increased. So now the question is, how does this increase in the duration affect the relative predictability of returns and dividend growth rates? Well, as the duration increases, both expected returns or shocks to expected returns and expected growth rates become more important. But which one is going to prevail depends on the persistence of this shock. As the duration increases, the shock that is more persistent is going to have a larger impact on price variation. So if we look at some of the estimates in the literature, we see that expected returns are much more persistent than expected growth rates. And the typical estimates for the persistence of expected returns are around 0.9, whereas the typical estimates for the growth rates are around 0.5. So this suggests that as the duration increases, we should actually see a more pronounced or a larger role for expected returns. So in this paper, we're going to provide 3 pieces of empirical evidence in support of our hypothesis. First, we look at the motivating example. We just look at the dividend strips. So we compare the equity market, so that's the aggregate market, that's a long duration asset, to short duration dividend strips on the same market. And we show that expected returns are much more important for the aggregate market than for dividend strips. So we use that as a motivating example. And then we turn to the time series evidence. And we see in the time series that as the payouts decrease, so as the duration increases, expected returns become more important. And finally, we turn to the cross-sectional evidence. In the post-1945 period, we form different portfolios, and we see that portfolios with higher duration have the largest role for expected returns. Okay. So how do we fit into the literature? Well, there's a fast-growing body of work that analyzes the implications of duration for asset prices. Most of the work is related to the term structure of equity returns or compares returns in the cross-section. In our paper, we differ. We use duration to explain the increased importance of expected returns, and thereby we provide a new channel that kind of helps us understand the relative contribution or relative predictability of returns and growth rates. Now, to start with the motivating example, let's go back to this example of dividend strips that I mentioned. Let's take the long duration asset, and then let's take the first dividend strip on the aggregate market as the short duration asset. So the long duration asset, you can think of it as the S&P 500, and then the dividend strip is just the asset that entitles you to the dividends that are going to be paid out by S&P 500 over the first year. We can then use the present value relations to link the duration to return and dividend growth predictability and link everything back to the variance of the dividend to price ratio. So to do that, let's simply assume that expected returns and dividend growth rates follow error-1 processes. In reality, processes are probably a little bit more complicated than that, but just to get the main idea across, let's just follow the extant literature here and assume that they follow error-1 processes. What's going to be here important is the persistence parameter. So expected returns have a persistence of delta 1. Expected growth rates have a persistence of gamma 1. Let's then also define the expected return, ER, as the fraction of the variance of dividend to price ratio that is explained by expected returns. And let's use EDG to denote the fraction of the variance of dividend to price ratio that is explained by expected growth rates. So then for the dividend to price ratio for the aggregate market, we know that it's going to be related to all the future expected returns and all the future expected growth rates. So the variance is going to depend on all the future variance of dividend to price ratio is going to depend on the variance of these shocks throughout the whole future. We can define the ER and EDG as follows using the familiar Campbell and Shiller decomposition. And then if we take the ratio of ER to EDG, so to see how important the relative shocks to expected returns are with respect to the relative shocks of dividend growth rates, we see that this ratio is now going to depend on the variance of expected returns over variance of expected growth rates, and is going to be pre-multiplied by the ratio that depends on the relative persistence of both processes, expected returns and expected growth rates. The more persistent are expected returns, the larger role that will play in the variance decomposition of dividend to price ratio. We can then also do the same thing for the dividend to price ratio for the dividend strip. However, here things are actually even much easier, because that dividend to price ratio will depend only on the one period expected return and growth rates in the future. So the ratio of ER to EDG over here is simply going to depend on the variance of both processes. So if we compare these ratios of ER to EDG for the market and for dividend strips, we see that for the market, they depend on the relative persistences of both processes, whereas that is not the case in the case of dividend strips, meaning that the more persistent process should be more important for the aggregate market and less so for the dividend strips. To test this empirically, we consider the typical VAR. We regress returns, dividend growth rates, and dividend to price ratio on the lagged values of dividend to price ratio. We do that for the aggregate stock market. And then we repeat the same thing for dividend strips, except that here we can skip the last regression. Based on these regressions, we can define the ER and EDG for both the market and dividend strips. And finally, we can define the ratio of those two. And what is actually super nice and simple and intuitive is that the ratio of ER to EDG actually just depends on the ratio of the predictive coefficients of in the return predictive regression and dividend growth predictive regression. Now, let's get to the data. So for the dividend strip, for the motivating example, what we're going to be using over here is just the dividend strips from 96 until December 2017. So we're first going to use the data from Binsberg and Brandt and Koudijs for the period from 96 until October 2009. And then we purchased the data, we carefully followed their methodology, and we extended it also to the December of 2017. So that's for the dividend strips. And here the maturity of dividend strips based on their methodology is between 2 years and 1.9 years and 1.3 years. So approximately the maturity of these dividend strips is approximately 1.5 years. And then for the aggregate market for the same period, we just use the data from DataStrip. Here are now the first results. So in the first column, we see the predictive regressions for the market. In the second column, we see the predictive regressions for dividend strips. For the market, as is well known, and we all seen these regressions often, returns are predictable by dividend to price ratio, significantly so, but dividend growth rates are not. So almost all the variation in the dividend to price ratio in this setup for the market is driven by expected returns. For dividend strips, we see a completely different picture. Dividend to price ratio for dividend strips predicts returns on dividend strips, significantly so, and it also predicts future dividend growth rates. Both coefficients are highly significant, and the R-squares are also very high. So the coefficients actually imply that approximately 30 to 40% of the variation in dividend strips is related to changes in dividend growth rates, and almost zero for the market. And note that insofar we are actually making any measurement error in estimating the prices of dividend strips, we are overestimating return predictability. So if anything, this is actually just the lower bound for the role of expected dividend growth rates in dividend strips. Anyway, this is just the motivating example, because we really like this example, because we have the same asset, the same processes for dividend growth rates and expected returns. The two assets, dividend strips in the market, just depend on whether we're entitled to all the future dividends or just the first dividend. And it's actually a great example to motivate and come across with our main idea. Now, let's take the thing to the time series. Here we're going to use, again, what we used before, our 4 centuries of prices and dividends. For 1629 to 1812, we're going to use the data from Netherlands and UK. Then we turn to the UK data for the 19th century, and at the end of the 19th century, we then turn to the US data. And the final time series goes from 1629 to 2017, kind of combining the 3 most important markets over the last 4 centuries. So in the first column, we see everything, what's happening in the data up until 1945. We see that dividend to price ratio predicts returns. It also predicts dividend growth rates. Actually, the estimated coefficient in the dividend growth predictability regression is even higher than in the return predictive regression, meaning that expected growth rates seem to be even more important than expected returns in this historical data, going up to 1945. In the recent period, however, this is the familiar result also from Cochrane 2011 presidential address, that in column 2, in the recent period, a dividend to price ratio just predicts returns, meaning that almost all the price variation is due to changes in expected returns. And as we noted before, this actually coincides with the decrease in the payout ratio. So just to illustrate this a little bit differently, here we estimate the fraction of expected returns and the payout ratio using 75-year rolling windows. And what we nicely see is that ER, so the dominance of expected returns, is increasing. Expected returns are becoming more and more important, and payouts are decreasing. Now note that a payout is the inverse for the duration. So ER and duration seem to be very much correlated. Obviously, in the time series, however, many things can be happening at the same time. So that's why we also turn to the cross-sectional evidence. And turning to the cross-sectional evidence, then we use the CRISP data, we use the Compostat data from 1945 onwards. For the initial years when earnings data is not available, we use simply the clean surplus approach following Chenda and Priestley. Then we calculate 10-year payouts for all the companies. We require non-missing earnings and also non-zero dividends. And based on these payouts, we then form portfolios of high, medium, and low payouts. So now, again, note that payout is inversely related to duration. So the low payout would mean high duration. So in column 2, these would be the results for the high duration portfolio. Again, we see that returns are predictable, dividend growth rates are not predictable. Just like for the aggregate market, because the aggregate market kind of over time became more and more like a growth stock, actually. Whereas for the high payout portfolio, which is the low duration portfolio in column 4, we see that both returns and growth rates are predictable. So for the low duration portfolio, we see that growth rates matter much more than for the high duration portfolio. Now, you could say, well, generally speaking, payouts were changing for all the companies over time. So let's just try to do an alternative way where we just simply require that payouts are below or above 0.5. So to kind of create a low and low duration and high duration type of portfolio. So if we do that, instead of creating these high, medium, and low portfolios, we again see the same type of results. We again see the same type of results, which is that below 0.5 portfolio only has the return predictability. Now, if we put things together a little bit, we see that the time series and the cross-sectional results are very much nicely aligned. In red columns or in red squares, you see the time series type of results connecting the ER to payout ratio or the ratio of ER to EDG to payout ratio. And we see that on these graphs, the time series evidence in red and the cross-sectional evidence in blue is nicely connected through the lines, meaning that both evidences are nicely aligned together. Now, one thing that you may actually wonder is, what about repurchases? So far, we only focused on dividends. Other forms of payouts, such as buybacks, actually became popular only after 1982. But we actually, in some robustness checks, find that the expected returns became dominant already before that. Also, in the cross-sectional portfolios, we considered also including repurchases, and we found very similar type of results. So that leads us to conclude that our results cannot be driven by repurchases. What about dividend smoothing? That's another thing that may affect relative predictability. Now, if companies pay out only the permanent component of earnings, then prices should still reflect or react to cash flow news. But if companies smooth dividends beyond that point, then that can affect also the relative predictability. So in many ways, smoothing is complementary to the duration effect, because when payouts decrease, it becomes easier for companies to smooth dividends. However, that cannot explain our dividend strip results. It can explain potentially the time series results, but not the dividend strip results. And also in the cross-section, we saw that dividend smoothing is not really correlated with our results. If anything, it's actually pointing in the opposite direction. Now, at the beginning, I presented simple present value relations to bring home the intuition that the aggregate market is more sensitive to changes in expected returns than short-term dividend strips. In the paper, we also develop a richer model with infinitely lived companies that pay dividends in each period, and they face trade-off between paying out dividends and reinvesting. We use this model to actually link duration to payouts and actually relate also the average value of dividend to price ratio to payouts and duration. At the end, we are able to show in the model, I'm not going to present the details over here, but in the model, we're then able to show also that qualitatively, as the duration increases, as long as expected returns are more persistent than expected dividend growth rates, we get more of, we get the dominance of expected returns as the duration increases. Now, to conclude, we argued that the impact of expected returns on equity prices depends on the duration of cash flows. If firms have lower payout ratios and cash flows to investors are pushed in the future, expected returns become more important. We document that with relation to dividend strips, time series evidence, and the cross-sectional evidence. So our message here, our bigger message here really is that expected growth rates do matter for prices, but in the recent period, they're masked by the increased duration of the equity market. So thank you.
Okay, thank you so much. Niels Gormsen is the discussant. You have 10 minutes.
Great. Okay, you all see this? Good. Okay. Yeah, thank you very much for having me to discuss this paper. I really like it, enjoyed reading it, and learned a lot from doing so. So the basic idea here is to, or the starting point for this paper is the observation that discount rates are really important for understanding variations in stock prices since World War II. But the authors have shown in the previous paper that actually before World War II, growth rates have been pretty important, at least in relative terms, for understanding price movements. And the basic explanation that the authors put forth here is that the duration of the stock market has gone up. So when the duration of the stock market goes up, what happens is that the stock market becomes more like a long maturity claim. Basically, you're to a large extent buying distant future dividends, and the authors are arguing that those are more exposed to discount rate risk. So this is an idea that's sort of been explored already in the cross-section of stocks, finding consistent evidence. Andre Goncalves in his JFE forthcoming paper, he's looking at sort of the difference in discount rate risk between long and short duration stocks, and he also finds that long duration stocks have more discount rate risk, and you can sort of use that as an explanation for why they have low CAPM alphas if discount rate risk has lower risk premium than cash flow risk. Now, what this paper is doing is it's sort of taking the same set of ideas and applying it to the time series to understand how the pricing dynamics of market portfolios varies over time. So I think I like that a lot. I'm basically just gonna give a few comments on what I think could be sort of made a little bit more clear in the presentation and of the paper, and some ways in which you can sort of further push the empirical evidence. So the starting point is the way the measure of duration. Duration is just the weighted time to maturity of future cash flows that an asset gives you. So in a Gordon growth type model, duration will just be the price to dividend ratio. So it's 1 over R minus G. This means that if we think that the duration has gone up over time, it's like saying the price dividend ratios have gone up over time. That's certainly true. It's likely going to be because either discount rates went down or growth rates went up. So previous studies have looked at sort of variation in duration coming from either growth rates, discount rates, or both of them. What the authors are doing here is a little bit different. They're instead measuring duration by saying, I guess implicitly they're saying that R and G are constant, at least G is measured in like the growth rate of cash flows. And then instead they're saying that the payout ratio, the amount of the cash flows that are paid out varies over time. So they're looking at variation that comes from payout ratios where payouts are dividend to earnings. And the idea here is pretty simple. Like if companies earn the same as before and the discount rate is the same as before, then if the firm starts paying out a lower fraction of the dividends, the timing of those dividends will be such that more of them are paid out in the distant future, and the duration will thus be will not be longer. Now, one issue I have with this thing is that in a frictionless asset pricing sense, we wouldn't think that payout policies by itself is super important. What we think is the timing of the actual cash flows, not the timing of the dividends. So to me, it would be more natural to look at a measure of the timing of the actual cash flows rather than the timing of the dividends per se. And if you use that approach, it just seems like it would require fewer assumptions than the set of assumptions you have to make now about what happens to discount rates in the back. And it also seems like all your results will still go through. Like it's certainly the case that the price dividend ratios have gone up over time. So duration measured in that way will sort of have the same secular moves as what you have with the payout ratio. And also in the cross section of stocks, we sort of also know that the things line up in the way it has to in order to be consistent with your theories. So that's one thing. I think at least I would like to see some more robustness that not everything is driven by this new way of measuring duration. So the next comment I have is the modeling approach you're using. Basically, the model is really nice because it's super simple and sort of easy to understand. One thing the model is doing is that it's assuming that there's just one discount rate that's the same for all dividend claims. So there's just one discount rate process that varies over time, which is nice for simplicity. But the problem is, of course, that the problem is that will be inconsistent with like the literature and the equity term structure that suggests that different dividend claims have different discount rates. And it's also consistent with like some of our leading asset pricing models like Campbell, Cochrane, Belmont, and Iran. So given that you're in a framework where you're arguing that there's a big difference between like near and distant future cash flows, I think it's nice if your model is also allowing them to be priced differently and have different expected return dynamics. So like one alternative would just be to like price individual cash flows on their own, like Notre and Vactor are doing, or Hansen, Heaton, Lee, or something like that. So if you do like the Notre Vactor model, it's actually nice and simple. You can just price each of the individual dividends on their own, and then the market portfolio is just the sum of all these dividends. And in their model, what they have, so I'm just going to quickly show this because I think it's actually a pretty neat way of summarizing the same findings as what you have in your model. But what they're doing is that they are saying the log prices of an end maturity claim is equal to the log dividends plus a constant times the loading on growth rates minus the loading on price of risk or discount rate. So what's happening is that sort of the pricing dynamic varies with the maturity of the claims, because some claims load more on growth rates, or sort of the loading on the growth rates and the discount rates varies with the maturity end. And once you have this expression, it is super easy to calculate how much of the variance is coming from cash flow, so dividends and growth rates, and how much of the variation in price is coming from discount rates, and see how that varies with maturity. So if you do that, you find a figure that looks something like this. This is the ratio of cash variance of cash flow, the variance is coming from cash flows to the total variance as a function of the maturity of the underlying claim. And here maturity is measured in quarters. What you see is exactly sort of the point you've been pushing, and you're pushing in the paper, that if you take the very near future claims, they're mostly just exhibiting variance that's coming from cash flow risk. They're very highly exposed to cash flow risk. And as you increases the maturity, the amount of cash flow risk decreases and the amount of discount rate risk also goes up, of course. So as you change the duration, as the market goes from being a short duration claim to a more of a long duration claim, you will increase the duration, the discount rate risk, or the importance of discount rate risk in prices. And I think this is a neat way of summarizing it. The challenge, though, is that how this figure looks depends on what these loadings and growth rates and discount rates are themselves. And that is a function that's model dependent statement. It depends not only on persistence is in those. I don't have time to show them here, but sort of we could talk later. But it's not only persistence, it's also like your assumptions about the stochastic discount factor and stuff like that, that's going to be important. So what I would do to make sure that this is not too dependent on a particular model is that I would sort of simulate all of the leading asset pricing models. Now you can see that this will work in the Campbell-Cochrane model. It's not immediately clear to me whether you'll find these kind of things in the long run risk model and stuff like that. So it would be nice if you could sort of work your way through those models and show that this is a general thing that in almost any model, as you increase the duration, you increase the importance of discount rate risk. Good. So with that said, I very much agree with this kind of idea that there's more cash flow risk in the near future than the distant future, and you have there's nice evidence in the paper that's sort of supporting that claim. I want to show you another figure that's from some work I've done recently with Ian Martin and Ralph Koudijs, where we're looking at the prices of dividends that are in the very near future on the European stock market. And the reason this is nice in this context is that in Europe you have these dividend futures that allows you to buy the individual dividends on the stock market, like the strips we just Benjamin just showed us. But you also have options on these futures, which allows us to construct a lower bound on the expected returns using the tricks from Ian Martin's QJE paper. So now when we're doing that, we can sort of see that, well, of course, expected returns do vary on these dividend claims, just like they do in the market. But so this is what I have in the left side here. It sort of depends a little bit on some assumptions about the correlation between the market and the dividends. I don't want to sort of put too much weight on that. The more interesting thing is the right-hand side over here, where you can see that this is the expected dividend. Now, if you take like one benchmark, which is just to say there's no risk premium, which is the blue line down here, you see that there is a massive, you would basically say the full drop in the price of near future dividends over the last year or so is reflecting cash flows, which means there's a massive drop in expected dividends of almost 50%. That's a very large change in expected dividends. Now, even if you start sort of putting in some risk premium here, it has a very modest effect on what's actually happening, or how much of the movement in prices that you can ascribe to risk premium versus discount cash flow risk. So this is basically saying exactly what the authors are saying, have been saying before, that when you look at the movements in prices in these dividend claims, they to a very large extent reflect expectations about dividends as opposed to discount rate risk, which is discount rates, which is exactly the main point. So I want to make a few comments on the empirical evidence. One thing is that I think you basically have three types of evidence. You have the time series evidence, the dividend strips, and the cross section. For the time series evidence, I think that's super cool. I love this long-term stuff. One thing that I'm thinking about, though, is whether there could also have been like secular changes in the data generating process going on in the background. So could it be that you just have more predictable growth rates in the early sample than in the late sample? I think that would be nice to sort of dig a little bit further into showing us that it's not just because dividend growth have sort of dividend volatility or expected dividend growth has disappeared, but it is actually this duration thing that's going on. Then the other thing is for the dividend strips, yeah, I like that evidence a lot. For the cross section, I think maybe that evidence, given that it's already sort of in this paper by Golez, I'll probably tone that down a little bit. And then instead, I will focus more on cross-country evidence. So what you could potentially do is you can construct a panel of different countries from 1990 until today using CompuStat. And then you can see whether there is a relation between the prominence of discount rate risk and the duration of the stock market in the different countries. And I think that would be nice. That would be very close to what you have in point one, but it would sort of take you away from this criticism that maybe there are just sort of fundamental different ways that we're pricing assets now than in the 19th century. Tyler, how am I doing on time? I think I might be running out. Is that correct?
Yes, you are just about up.
Okay, good. Then I just want to make one last claim we can maybe talk about later, that sort of this this maturity dependent discount rates could actually be important, but I'll send the slides to you and you can look through this and we can talk about it. But all in all, I think this is a super nice paper that emphasizes the importance of duration. I would I think it's making a really nice and clear point, but I would like to see some robustness towards other measures of duration. You can think about like this model, you could use it or not, but I think it's useful to have a model that allows for dividend claims with different maturity to have different pricing properties. And I think it would be super cool with some cross-country evidence. Thanks a lot.
Okay, thank you. I'll give the authors a minute to respond. And then also we have a question in the chat from Julio Cesar Fernandez. Can we really say that expected returns are more persistent than dividend growth rates? And basically, how does that affect the results? Would that negate the paper's result if the opposite were true on the persistence?
Well, thank you very much, Niels, for the discussion. I would very much like to see your slides as well. So thank you in advance for sending that over. I'm going to try to briefly answer your questions and also the Julio's question. Starting with actually Julio's question, yes, it would negate. It is important that the expected returns are more persistent than expected growth rates. That actually is an important thing here. And that actually also goes to Niels' comment. Yes, in all the leading asset pricing models, you see the larger impact of expected or discount rate shocks as you increase the duration. But what's really important over here is the relative importance of discount rate shocks with respect to growth shocks. Because in most models, also as you increase the duration, both amount of the discount rate risk and amount of the cash flow risk increases. So what's really important is the relative importance of both of them. And that's why, at least in the very simple present value model setting, the persistence matters a lot. So if you would have more persistent expected growth rates than expected returns, you would get exactly the opposite prediction. Now, looking into all the papers that estimated the persistence of expected returns or growth rates, including Binsbergen and Koudijs, or Ravi Jagannathan also has a paper. I have one paper on that. We all always find that expected returns are more persistent than expected growth rates. So now on that, Niels, I very much agree that it would be nice to also use different measures. We like the payout ratio because it doesn't depend on prices. Alternatively, we checked everything with simply using the dividend to price ratio as an alternative measure for duration, because the inverse of dividend to price ratio in the Gordon growth model is in its own already a measure of duration. Maybe we could also use for the recent period something more accounting based, as you suggested also there. We could also definitely work a little bit more on the different dynamics and look more specifically in different models. Actually, I quite like that suggestion that we would actually go through all the models and see what the leading models actually imply, not just present the evidence in the present value model. And lastly, regarding the cross-country evidence, it has crossed our mind. Definitely, one problem there is that it's difficult to compare, the counting standards with respect to earnings across countries. But if we actually use some type of more simple measure of duration, potentially we could do something along these lines. Although we always, as you know, like to have a long time series, and if you go to the cross-country setup, then you are a little bit restricted with the time series. But again, thank you very much for your comments and looking forward your slides.
Okay, great. Thanks so much. We're basically out of time, so I'll move to the next presentation. Toomas Laarits will present pre-announcement risk. You have
All right. Thank you, Tyler. Is my sound all right?
Yes.
All right. So thank you, Tyler, and thank you everyone for being here. So the motivation for this paper, I think, should be familiar to attendees of prior AFA conferences. So as Luca and Munch show in the 2015 Journal of Finance paper, the aggregate equity market on days when the Fed, the policymaking body, FOMC, is scheduled to make announcements, sees high average returns. Okay, so here in the red solid line, I'm updating their main finding out of sample to show you that if an investor would have bought the aggregate equity market at 9:31 a.m. on day when the Fed is scheduled to make an announcement, from 1994 to 2019 would have made an average of 22 basis points, okay, per occurrence. And now this compares to kind of unconditional equity risk premium of 3%, 3 basis points per day. Right, so you don't need me telling you it's a very puzzling empirical fact. First of all, the magnitude, of course, is quite substantial. We have 8 scheduled meetings per year, 2-day pre-announcement return of 43 basis points. So you get 344 basis points of return by holding the market in those very 16 traded days out of 252, which average annual excess return in the same period is over 800 basis points. And, kind of fun, principles of finance say excess returns should be earned when uncertainty is resolved. So the question I want to tackle in this paper is, well, what is this uncertainty? What is this risk that is resolved in this pre-announcement period? Okay, so that's the goal of the paper, to propose and test a risk-based account of this pre-announcement risk. So what is the main idea of the paper? The main idea is, well, what I want to argue is there's a very tight link between how market participants interpret the Fed action, Fed statement, and with information that the market participants and the Fed learn in the run-up to the announcement. Okay, and here I'm building on this recent literature that's shown that there's at least 2 ways to interpret any given Fed announcement. Okay, now one traditionally, the Fed has some discretion over the short-term interest rate. So whenever we learn about the path of a real rate going forward by Fed action. But secondly, whenever the Fed speaks, we learn something about the Fed's private information about its growth expectations. Okay, the so-called Fed information effect. And let me start my timer as well. So what is the main empirical claim? The main empirical claim in the paper is that the way investors kind of learn how to discriminate those 2 different interpretations of Fed action depends crucially on information that they observe in the run-up to the announcement. And the main theoretical claim will be that this feature of the Fed announcements leads to a risk premium that's earned in the pre-announcement period. Okay, so let me, what do I mean? But let me just kind of fill in a bit more on those 2 types of interpretation and how I will discriminate between them empirically. So here I'm going to rely on recent work by Cieslak and Shrimp and Boyarchenko and Koudijs, who look at, in a very tight window after the Fed announcement, the realized stock bond covariance in response to the Fed announcement. Right? So as you can imagine, say the Fed announcement was primarily interpreted as news about the real rate going forward. Well, suppose the real rate went down, we would expect both stock and bond returns to be positive, on account of the risk-free discount being lower. Now, in contrast, suppose it's news about the growth rate of the economy, the Fed information effect. Well, if the growth rate of the economy goes, is now revealed to be higher than expected, we'd expect stock returns to do well on account of the, cash flow component, whereas we'd expect bond returns to be negative on account of the, intertemporal elasticity of substitution term in the risk-free rate, right? So looking at the realized stock bond covariance right on announcement, we can discriminate between those 2 potential interpretations of Fed action. And what I'll show you empirically is that if recent news has been poor, the market tends to interpret the cut in Fed funds rate primarily as a sign of lower real rates going forward. How, in contrast, if recent news has been positive, the market tends to interpret cuts in Fed funds rate as a signal of low growth expectations on behalf of the Fed. Okay, and let me just show you 2 pictures to make it even more tangible. So first on the left, I'm showing you the Fed meeting from December 16th, 2008, so during the global financial crisis. So the Fed at 2:15, when they made the statement, surprised the market by a cut of 10 basis points. What did the market do in response? Both the stock market and the 10-year bond market rallied. So we had a positive stock-bond covariance, and this is kind of the textbook or finance textbook view of a monetary policy announcement. In contrast, if you look at just the previous FOMC announcement on October 29, 2008, again, the Fed surprised the market by a cut of 5 basis points this time. However, the markets kind of shrugged it off. The equity market, in fact, lost value in response, and bond market gained some. Okay, so my interpretation is this announcement was seen as a vote of no confidence in the economy by the FOMC. All right, so what I want to do empirically today is show you that these two announcements reflect a systematic pattern that can account for the pre-FOMC return evidence. And the one-sentence summary will be: the pre-announcement resolution of uncertainty about the announcement type commands a risk premium. So let me get to it. So I'll have 3 parts to my presentation with, I think, 19 minutes left. So first, I'll show you a 2-period model in which such a pre-announcement risk obtains, and I'll say a few words about the timing of it. Then secondly, I'll go to the data and show you the empirical counterparts to the main assumptions in the model. And thirdly, time permitting, I'll just say very quickly a few words about other explanations, particularly the leaks hypothesis that has been proposed in the literature. All right, so let me talk about the model. So consider the following 2-period setup. Okay, at time 2, the Fed is scheduled to make an announcement. And we have a representative investor here with Epstein's preferences. And let's furthermore set the EIS to 1 and the risk aversion above 1. So the Fed is scheduled to make an announcement at time 2. The announcement could be about the path of short rates. Denote this as an epsilon shock, or it could be about growth expectations. Denote this as an eta shock. Okay. Now, whether the Fed makes a growth rate shock or a short rate shock depends on some state variable x that is resolved in a prior period at time t1. Okay. Now, how does the Fed communicate? Well, the Fed just reveals some random variable phi, call it the Fed funds rate, but the interpretation of this phi depends on the realization of state variable x at time t1. Okay. So before the announcement is made, everybody already knows what the state of the economy is, what type of shock will be revealed. But crucially, people don't know what the realization of phi will be. Okay, there's no leaks from the Fed. Now, the key assumption I will make in the model is I will directly specify the value function in the terminal period. And the key assumption I will make is that the value function is more sensitive to the interest rate shocks from the Fed, from the real rate shocks, than it is to the growth rate shocks. Okay, so there's epsilon shocks here that enter the value function with the parameter lambda are more important in terms of the value function than the eta shocks. Okay, and by the way, this doesn't mean in some kind of absolute sense that short rate shocks are more important than growth rate shocks. It just means that as stemming from the Fed announcement, the Fed is going to able to move investor value functions more when it makes the epsilon announcement. Now, as you can imagine, under Epstein's inutility, if the value function is more sensitive to the epsilon shocks than to the eta shocks, then at in the intermediate period at time t1, the value function is lower in the x0 state just by virtue of the continuation value component of current utility being lower. You see, if x is 0, I get the more volatile shock in the future period, which results in a lower value function today in time t1. Okay, so this is and with this setup is kind of enough to get a risk premium resolved in from period 0 to 1. So let me show you how. The log SDF, remember we had assumed Epstein's preferences, is just the usual innovation in the consumption with the coefficient -1, and innovation in the value function with a coefficient of 1 minus gamma. Now, any payoff at time 1 that depends on the state variable x, remember state variable x is what determines how the announcement is interpreted. Any such payoff will earn what I call a pre-announcement risk premium. Right? Why? Just by virtue of the announcement type being a function of x and the value function reflecting it, any asset that also, for whatever reason, depends on the innovation to x will earn a pre-announcement risk premium. Right? So that's the principal theoretical claim I make in the paper. All right, and crucially, all this happens without anyone leaking the realization of phi, right? It stems from the difference in risk premium on announcement, that the different announcements have different riskiness to them, and it doesn't depend on anyone learning the actual realization of Fed action. Right, so let me say really quickly, when should this, how should this risk premium be resolved over time, right? And in the previous slide, I showed you 2-period models. So, the risk premium is resolved from time 0 to 1. When in time should we expect to see this pre-announcement premium? Well, turns out it really depends on the persistence of the state variable x that determines the announcement interpretation. Okay, so suppose this x follows an AR1 process. It's a mean reversion, and now when an investor, the discount in anticipation of Fed announcement, an investor needs to price, say, the aggregate stock market. What do they need to do? Well, they need to predict where the state variable x will be at the fixed point in time when the announcement is made. Okay, and now if this process is sufficiently fast mean reverting, this uncertainty will be resolved in a very tight window in the run-up of the announcement. Right, just kind of generic statement. If I'm predicting the value of an AR1 at a fixed future point in time, well, this uncertainty will be resolved at an increasing rate as I get closer to the announcement time. Okay, so let me skip the derivations here, but it will look something like this in the graph. This is here I'm fitting the theta from the kind of mean reversion parameter in the AR1 from data that we see empirically. And you see if it's, I think here the value is 0.77. So because it's a very fast mean reverting process, kind of as you get closer and closer to the announcement, the uncertainty is resolved at an increasing clip. So empirically, you see this pre-announcement drift in just a very few days before the announcement is made, or at least a statistically significant one. All right, so that's the 2-period model. So the claim is there's a very tight link between announcement and pre-announcement dynamics, and I kind of have 3 main ingredients. So ingredient number 0, there's at least 2 different types of information that could be learned from Fed announcement. Ingredient 1, these 2 different types of announcement are differentially risky. They command a different risk premium. And assumption 2, that these announcement types are at least partially predictable using pre-announcement information. Okay, so what I want to do now is just show you direct evidence on these 3 assumptions. Okay, so first, assumption 0. Here I'm just relying on existing literature that uses this realized stock bond covariance on announcement time to quantify which type of information was more important at a given announcement. Of course, in practice, they're always both there, but one or the other can dominate. And so here I'm showing you the realized stock bond covariance meeting to meeting. As you can see, from meeting to meeting, there's a lot of variation on which type of information dominates. Okay. Now, secondly, let's look at average returns right after announcement as a function of the realized kind of announcement classification. So what am I doing here? I'm taking from the previous graph this realized stock bond covariance in a short window after the announcement is made. And I'm classifying all this pre-scheduled announcement into 4 bins. So the pin 1 here, Q1, is the announcements that are primarily classified as being about the information effect, Fed's view about growth rates going forward. Bin 4 here is the announcements classified as kind of traditional monetary shock, about short rates. And what you'll see is the average return. Let's focus on the red bars here. The average return is increasing as we go from Q1 to, from the first quarter to the last. In other words, the announcements that are classified ex post as a traditional Fed shock command a higher risk premium on announcement. And the key part really is what I'm showing in the last column here in the last part, which is the difference in the risk aversion, in the risk premium as a function of those two announcement types. Okay, because this is remember what I said in the model, that the investor value functions are more sensitive to this, the type of the short rate shocks. So on average, we get a much higher return. Investors get a much higher return on the announcements that are classified as having been about short rates. And assumption 2 is that this differential risk premium on announcement time is at least partially predictable. Okay, so let me show you evidence in favor of that. So what I do here is I do a regression where on the left-hand side, I have the realized stock bond covariance on announcement time. And on the right-hand side, I just use, say, on the first column, the realized return on the market from market open to announcement time. So what does this regression mean? It means if the realized market return from in the morning, up until the announcement was negative, then I can predict, large and positive realized stock bond covariance, right? Poor news in the pre-announcement period, as reflected by poor market return, predicts this risky announcement type. You see, so that's direct evidence that this announcement type, as measured by the covariance, is predictable. And by the way, if you try to predict the announcement itself, the realization of the Fed funds rate, you get it's much more difficult, and there is no such predictability. But there is predictability in kind of the announcement type, if you will. Okay, so in a way, this is the hardest evidence I have. Okay, I have classified announcements. I have shown the difference in risk premium as a function of the classification, and I've shown you this predictability. I also want to, briefly show you some softer evidence that I personally find quite persuasive, though. So let's see. So, namely, evidence from Fed transcripts. Okay, so what is the key assumption in the model? Put differently, both Fed and the market participants in the model condition their action on some state variable that they learned, in the run-up to the announcement. Okay, kind of very recent news. So what I find is that transcripts of 93 of the 168 meetings from 94 to 2014, the transcripts are released with a 5-year lag, contain discussion of some macroeconomic news that was released in that morning. Okay, many more with discussions of stock market, bond market, Fed futures market, etc. So let me show you one example that I particularly like, though it's no way unique. So this is from January 30 to 31st in 2001. There's a 2-day meeting. As you can see from the table distributed at lunch break, the conference board's expectations index, which was released this morning, fell sharply in January. Okay, they're talking about news that was revealed that morning. Then Chairman Greenspan says, I wanted to cut rates, but I was worried that cutting rates so fast would suggest either knowledge of facts that nobody else knows or that we're getting scared. Fortunately, I guess the markets, as a result of yesterday's consumer confidence index, have now put something like a 20% probability in a larger move, so we can cut without worrying the market too much. Okay, so you see here, Greenspan, they're looking at recent news. They're looking how the market adjusts their expectations in response to recent news, and saying, we can change what we're going to do because the news has given us more leeway. And as a final comment, then after listening to the television a bit this morning and seeing the degree to which there were high expectations of an even bigger move, I came around to your view, Chairman Greenspan. Right, so it's kind of just text, examples, but underlying the view that both the Fed and the market put a lot of weight on very recent events as to figure out how to kind of read the tea leaves. And by the way, there's some work recently, particularly in Stein and Sundaram 2018, that describes this kind of equilibrium of focusing on very recent news as an equilibrium outcome of a kind of communications game between the market and the Fed. But I don't want to say much more about that at this talk. But that's in the background. But to kind of quantify the evidence I just showed you from transcripts, I do a very simple kind of textual analysis of counting how much does the Fed, how much do policymakers use terms such as this morning or this week or the market, and I just measured the frequency of such terms, and precisely in times when they use these terms a lot, you see an average a much higher pre-announcement return. Okay, so that's in the time series. Now, so in meetings where the Fed tends to talk a lot about the market, assuming that presumably there was lots going on in the market, is precisely the times when we see a much stronger pre-announcement drift. And Tyler, I have 5 minutes, correct? All right. So
Yes.
let me show you some more time series evidence, just to underline the regularities in this pre-announcement return. Here, what I'm doing is I'm just sorting the 208 meetings in the sample based on conditioning variables known before the meeting. So in the top left here, let's look at it in the top right. I'm just conditioning on the level of the VIX the day before. And what you'll see is precisely in times when VIX is above median or in the 4th and 5th quintiles, kind of at risky times, you have a much stronger pre-announcement drift. And of course, and same holds if you condition on the implied volatility of the Fed funds rate, or if you condition on the realized risk premium on Fed funds futures contract in a trailing window of 1 year. Right, so kind of all those time series indicators you would think pick up times when there's more uncertainty about the underlying market, or in the bottom row here, kind of more uncertainty about what the Fed will do, precisely see a stronger pre-announcement drift. And let me show you one more figure. What I'm doing here is I'm calculating 8 meeting moving averages, or equivalent to 1 year moving averages. In the solid blue line is just the 1 year moving average of the pre-announcement drift. And what I'm showing in the red line here is the moving average of the VIX for the same meetings. And you see, there's a very strong kind of time series correlation here. And of course, right after the pre-announcement drift was first published in 2001 here, it turned negative and was quite weak in the data. I don't think it's, perhaps consistent with the view that no one had noticed this before. That said, it was also a time when volatility was very low. So as volatility has recently returned to the market, the pre-announcement drift has also returned to positive territory a bit. So let me just say very quickly something about what I think is perhaps the leading alternative hypothesis. Right, the leading alternative hypothesis, what gives rise to this data, is the Fed could just be leaking data. Okay, that there's some market participants who know the realization of the Fed funds, what the Fed will do before the rest of the market knows. Now, I think a simple test of the leaks view is that under the leaks hypothesis, the realized market return before the announcement is made, or to predict with a positive sign the market return on announcement time, right? That's what we'd expect if there's, part of the market that learns the information beforehand. Turns out to be the case. What I'm showing in the first column here is the market return pre-announcement does predict the market return post-announcement, except with a negative sign, right? So good returns pre-announcement actually predict poor returns post-announcement, which in my view, that goes contrary to the leaks hypothesis, or at least the simple leaks hypothesis, but it's very much consistent with the view that what we learn in the pre-announcement period is the risk premium post-announcement, right? And if that's the case, you should exactly expect a negative autocorrelation in the data. And similarly, there's no predictability. There's very little predictability in the actual Fed funds rate realization, and that too goes in the wrong direction, if you will, with respect to explaining the pre-announcement premium. Okay, so I think I have 30 seconds, so let me just go to the end. So the argument in this paper is that the interpretation of monetary policy news depends crucially on news learned just before the announcement. And this resolution of uncertainty about the announcement time risk gives rise to high expected returns before the announcement is made. So with that, let me thank everyone for being here, and I look forward to Nina's comments.
Okay, thanks so much, Toomas. the discussant is Nina Boyarchenko.
Great. Thanks, Tyler, for inviting me to discuss this paper. Hopefully you guys can see my screen, and let me close out of this. So as always, these are my views and not the views of the bank or of the system. So just to give you a one-slide summary of Toomas's paper, and the basic idea is that economic news ahead of FOMC announcements or the morning of the FOMC announcement color market participants' interpretation of policy announcements. The way to think about this is that if the market or the Federal Reserve sees positive news going into the meeting, then policy changes are going to be more likely to be interpreted as being due to changes in economic conditions. So the monetary policy, quote unquote, shock is going to be more likely to reflect changes in the Fed's expectations of future economic growth. Whereas if the market has seen a lot of negative news going into the meeting, then policy changes are going to be interpreted as being more reflective of changes in the policy stance. As Toomas explained, the way that he's going to figure out which announcement is which is basically based on high frequency stock bond correlation, with the idea being that if we have a positive correlation between the stock market and the bond market, then that's more likely to be the so-called classical monetary policy shock. So changes in the policy rate due to changes in the policy stance. Whereas a negative correlation is going to be more suggestive of announcement that contains information about growth or future growth rather than the stance of monetary policy itself. And so what's going to be crucial for all of the empirical exercises in this paper, and kind of by definition, this paper is an empirical paper because it's trying to figure out the explanation for a pre-established empirical fact. The crucial piece is, of course, going to be the actual identification of monetary policy shocks. And so in the paper, Toomas is going to use Fed funds futures to identify monetary policy surprises. Now, he is, of course, not alone in using that approach to identifying surprises, but there is a building literature that shows that monetary policy surprises are multidimensional. I mean, in a way, thinking through the basic hypothesis of this paper also assumes that monetary policy surprises are multidimensional, in which case you have to wonder why we're using only a single instrument to actually identify what those monetary policy surprises are. So in a paper I did with Valentin Haddad and Matt Plosser a few years ago, we actually looked at a slightly expanded way of measuring policy surprises. And in particular, instead of just focusing on the Fed funds contract, so think of this as essentially the shortest maturity term structure instrument you can have, we identified policy shocks from the term structure going out to 10 years in maturity. And it turns out that you really do need at least two factors, maybe three if you squint at it, to actually explain what happens to term structure on monetary policy day, announcement days. And in fact, if we think about which factor is more important for explaining more of the variation on announcement days, the classical Fed fund surprise explains less than the other factor that we uncover. Now, these two factors are going to have differential relationship with other risky asset classes. So here I'm showing you the results from the market, but you can also look at, for example, the results with volatility like Toomas was looking at. And in fact, it's in most cases, it's going to be this other factor, so the factor that's not related to the Fed funds announcement, the Fed funds futures, that is actually going to be driving the relationship between the changes in term structure on announcement days and changes in other asset classes on announcement days. Now, related to this is actually the sample that Toomas uses. So in doing papers like this, since there are only 8 meetings per year, there is a temptation to, of course, go as long of a time series as you can. So Toomas uses the full 94 to 2019 sample. Now, there are a couple of issues with going whole hog here. So first, of course, is going to be the fact that out of that sample, 6 years of that sample was spent at the zero lower bound. So meaning that around 1/5 of the sample, if we're just looking at monetary policy surprises as measured by the Fed funds futures, we're essentially spending in a regime where we are not really seeing any monetary policy surprises because the market was very cognizant of the fact that the rate is going to stay at the effective zero lower bound for a very long time. Now, sort of related to that is the flip side of this, which is that during the crisis, and I mean, this is a little bit outside of Toomas's sample, but again, during the current pandemic, monetary policy announcements were not just made during scheduled meetings. If you think back to the crisis, there were all sorts of programs that were introduced to support the economy, where the introductions happened outside of the regularly scheduled FOMC calendar. And again, you may wonder to what extent are those actual monetary policy announcements? If they are, what does it mean that those types of announcements get, as far as I could tell, at least get ignored for the purposes of the empirical study in this paper, et cetera, et cetera. So in the interest of getting us close to being back on time, so I want to conclude by saying that I do think that this is an interesting potential explanation for the pre-FOMC announcement drift. Again, there is a lot of evidence in the literature that that monetary policy announcements are not unidimensional. So it does make a lot of sense to me that you can think about what happens at a meeting as having both a component that tells you something about the stance of monetary policy versus the central bank's expectations for future growth. But I do think that Toomas should do more work in convincing the reader that this covariance way of thinking about which shocks are which is actually the right way. There are a few ways of going about that. One is, of course, to use the survey of primary dealers to actually figure out what it is that the market is thinking about going into the meetings. Why the survey of primary dealers rather than alternative surveys? Well, first of all, the survey of primary dealers is the survey that gets conducted closest to the meeting. So you're more likely to actually be capturing the information that market participants are thinking about going into the meeting. The other part of that is that primary dealers, are the biggest participants in a lot of these markets. So to the extent that their opinion reflects what the market is going to be doing, that's probably a better measure than some of the other surveys. The other, the final nice thing about the survey of primary dealers is that there are special questions sometimes. So you can actually maybe even figure out whether market participants are expecting for the policy stance to actually change at the given meeting. Now, the other way of going about this is to actually look at meetings at which we know that the policy stance changed. And again, in this longer time period, there are a few meetings you can actually look at directly. So the meeting, for example, the introduction of forward guidance, because again, of course, forward guidance was not really an explicit monetary policy tool until the financial crisis. Similarly, things like the introduction of the survey of economic, the survey of participants, which again is a way for you to actually think through, you know, what do the voting members of FOMC think about, how has their expectation, or at least their public revelation of expectations about growth rates changed. And I mean, there are many more examples that you can think through, and I'll end there.
Okay, thank you, Nina. Toomas, I will let you respond to Nina, and then there's a couple questions in the Q&A if you want to take those as well.
All right, thank you. And thank you, Nina, for your discussion. So let me just say very briefly, you know, with respect to there being multiple, you know, the Fed announcements being multidimensional, you know, you're preaching it why I couldn't agree more. And, you know, in the presentation, I kind of at some point said, there needs to be at least two ways the announcement can be interpreted. I agree, there's probably more than two kind of shocks in there. For the purpose of this paper, I can try to keep it as simple as possible. So I used a 10-year bond and aggregate stock market covariance. Now the papers I took it from, Seas Like a Shrimp in particular, they use more assets. They look at a short-term bond with the market, long-term bond, tips, etc. So you can kind of do more fine-grained analysis of what the information, you know, structure, what the information really was that the market learned. I do want to say I don't actually use Fed funds surprises in most of my analysis, right? Because after all, what I'm doing is I'm calculating this realized stock bond covariance and predicting that. So I'm not using the Fed funds surprise. But you know, your point is well taken. There's a long period where there were no Fed funds surprises because we were stuck at the zero lower bound, and that kind of works against me. So I didn't want to throw those events out. You know, they kind of lower. That is a period of weaker pre-announcement, precisely in my view, because there was kind of one piece of uncertainty taken off the table when the Fed spoke. Now, why don't I include other Fed meetings? Well, in part just because I'm replicating Luke on Munch. Some of the other meetings were scheduled with very short notice, so I definitely don't want to include those, because then you might contaminate the pre-announcement period with, you know, news that actually led to a decision to hold the emergency meeting. But I don't show this in the paper, but the pre-announcement drift also exists for kind of other Fed meetings that were scheduled further in advance, though they weren't regularly planned meetings. I do have a table at the very end of the paper, about page 90 or so, from the survey of primary dealers. So I do find quite a bit of variation in the, you know, in what they describe as what they expect to be most important for the Fed decision making. I couldn't really feel that I could quantify it well enough and with high enough frequency to use it as kind of the main empirical analysis, but at the very minimum, I thought they do show this time variation in their belief on what the Fed will pay attention to. Though in that respect, I still like the Fed's, you know, own FOMC's own words better in describing their decision-making process. Let's see, anything else I should address? There was a comment from the audience regarding that most Fed decisions are anticipated in advance. That's a very good point. So, you know, everything I do in this paper, I'm always, you know, looking at the innovations, right? So when I showed you the Fed funds surprises, those are of course calculated. Those are calculated, you know, in terms of innovations using prices of Fed funds futures before the announcement is made. So of course, you know, all the action that's anticipated should not matter at all, and I don't find that it does matter. But the innovations is what they use. Yeah.
I'm sorry. I'm gonna cut you off there because it's gonna end abruptly in about 1 minute. So I want to thank everyone, all the attendees for coming and for all the questions that you asked. And I want to especially thank all of the authors and the discussants for a really great and interesting session. Unfortunately, we can't do it in person, but I thought this was great and really interesting to hear what everyone is up to. So with that, we will conclude the session. Hope everyone has a great rest of their AFA.
Thank
Thank
you.
you very much.
Thank you.
Hey, Tyler and everybody, thanks very much. I'll end the meeting and the recording as well.
Okay, thank you. Appreciate it.
Thanks a lot. I'll see you next time.
Thanks.